Welcome to the SpreadX Weekly Financial Market Preview. I'm joined again by Analyst Connor Campbell. And first of all, we're going to look at cable.
Yeah, cable sort of continuing its springtime decline. There hasn't been any sign at all that it's going to stop. It's sort of since mid-April, really sharp decline. This week doesn't really have anything that could help turn it around either. I think the main focus in the second half of the week is Friday's non-farm jobs report, and if analyst estimates are correct, it's a fairly solid one for the dollar. I think wage growth, which will be probably the focus of the three main figures, wage growth is expected to jump back from 0.1% to 0.3% month on month. That's a return to the kind of levels that I guess could give the dollar a hawkish boost. I think you've then got unemployment rate expected to hold at, multi-year lows of 3.9%. Then I think the non-farm figure itself is expected to bounce from, 164k to 190k month on month. So again, three solid figures that, whilst I doubt it's going to give the dollar a huge boost because the dollar is looking so strong against both the euro and the pound at the moment that there's not necessarily room for much growth from some just solid but unspectacular figures. However, it does mean that the pound doesn't really have any room to improve unless there is a severe miss in terms of those figures on Friday. In terms of what our clients are doing, we have got people sort of fishing around at the bottom at 1.325, trying to find the bottom, trying to find sort of
we saw that last week as well.
Exactly, the end of this very long decline. However, we have got sellers coming in at those levels as well, I think, looking for the pound to dip back below 1.32, just because the odds at the moment are stacked against it. You sort of got Brexit as an ongoing concern and amazing stability, and everything coming out of the US really data-wise has been fairly positive at the moment, or in terms of the macro environment, despite sort of the re-emergence of the US-China trade war kerfuffle. Everything seems to be double positive at the moment, mainly due to sort of pound weakness, and that seems to be playing into the pound's continued issues currently.
Yeah. And a quick look at some stocks. So we're going to look at just the Card Factory.
Yeah, Card Factory, they're reporting their first quarter figures on Thursday. Sort of been a bit of a mixed year this year. I think it plunged 20% in January after some not particularly great Christmas figures, but then since then has sort of bounced back. It was at a 3-month high of 250 in April after its full-year figures. Its full-year figures were okay. I think revenue was up 6% to 422 million. I think like-for-like sales were up 2.9%, which is pretty healthy. However, pre-tax profit dropped more than 12% to 72.6 million pounds, mainly due to the weaker pound and higher wage costs and things like that impacting on the company's margins. I think the company also said that it wouldn't be profitable until 2019, which again, not great. I think it's looking for those sort of a weaker pound, especially to ease off in the next couple of years and for it to implement its own cost-cutting initiatives, but that is going to take a few years to come into effect. However, investors were still sort of broadly on board with the stock because it raised its dividend, I think, by 1.6% for the full year and promised that there would likely be a special dividend announced with its interim figures a bit later in the year. I think that's why investors are still hanging about. They're sort of clinging on for that interim dividend in a few months. In terms of its first quarter figures on Thursday, a lot of the company's growth at the moment has been based around low-margin non-card items, and card sales themselves have been a bit lackluster. Obviously, I think ideally investors would see some kind of improvement in card sales on Thursday. However, given Royal Mail's sort of repeatedly falling letter volumes and letter revenues, that seems unlikely. So I think investors are going to be looking for the continuation of its decent 2.5 to 3% like-for-like sales growth. If it does that, it can maybe return to the 250 levels it sort of pulled away from the last few weeks. In terms of our clients, they've been buying around the 220 mark. In May, it's been trading between 220 and 230. Yeah. They've been buying at the bottom end of that range, I think, looking for some kind of bounce if it continues its like-for-like sales growth on Thursday.
Okay, we shall see. Thank you very much. That's all for this week.